Hello and welcome everyone. This is Binam, and in this video I'm going to show you the application of dividend discounting model in order to compute the price of a stock. When such a model is applied, the derived price is also known as the theoretical price, sometimes also called the fair value or the economic value of the stock. Remember, in order to apply this model, the company should have paid the dividends. This basically means some companies such as Netflix or Amazon, which have not paid the dividends so far, we cannot use the model to find the share price for those companies. The second thing is regarding the assumption related to dividend growth. The dividend paid by the company may not grow, which means they may remain same all the time. They may grow at a constant rate and they may grow non-constant. Now, in all these three cases, the formulas to be applied will be different. I'll be showing you all this with the help of the real world example, so there is nothing to worry. So you can see here, I have downloaded the dividends paid by the four companies, and they are for the period 2015 all the way to 2020. So 5 years share price have been downloaded and they paid the dividends quarterly. So you can see there are 20 rows of dividend per share information for all these four companies. If you would like to download these dividends paid by the companies, that's very simple. You just go to Yahoo Finance, type in the name of the company such as GM for General Motors, and then you will be able to see the share price such as $38.96. That's what I have copied here, 38.9, and that's the share price. You can also find out the beta, which is 1.35 for General Motors, and that's the information I have taken. And also in relation to the dividend per share, you can click historical data, and instead of historical price, take the dividends, which is here. And when you click it, by default the period is 1 year here, so you can change it to, let's say, 5 years. So now you're capturing 2015 to 2020. Maybe you want to change the frequency to monthly so that you have less rows in your dividend related information. Then click apply, and you can see this is 0.38 all the time. Of course, there is one which is 0.36, and that's what I have also downloaded and made available here for my computation purpose for General Motor. I've done the same for Walmart, Microsoft, and ExxonMobil. So this is the dividend per share data. Now, in order to apply the dividend discounting model, we need to know the required rate of return, and one method to find the required rate of return is through the application of the CAPM model. So you know, in CAPM model you need to apply the formula, which is this formula here. So I'm going to copy this formula, paste it here so that you can see what I will be doing in order to compute the CAPM given rate of return, which is mentioned here. CAPM given rate of return. So I need risk-free rate plus beta, the market return, take away the risk-free rate. Now, first thing first, the market return. Market return, I can assume that the market is S&P 500, so I can therefore go to again Yahoo Finance. I can type in S&P, and then this is the one. And for S&P 500, I will go to historical data, which is here, and then 5-year period is already here, and historical prices. Monthly is fine. I click apply. I can see 3,509 as of end of October 2020. So 3,509, and in the beginning I have 2,043. So 3,509, 3,509, and it was 2,043 at the start. So this then basically means the market return will be equal to 3,509 divided by 2,043, and this is power 1/5, because 5-year data take away 1, so that is giving me 11.43, and that's what I can copy it across, and that's what I have just done. So I now have market return, expected market return. Then I need risk-free rate, and I will have treasury bill yield as the risk-free rate, the proxy for risk-free rate. So again, I can go here, type in treasury, and treasury yield 10 years is what we can take as a good proxy of the risk-free rate, which is 0.958. So that's what I'm going to type in here, which is 0.958%, and that's what I'm going to copy across. So now I have everything to give me CAPM given return as required in this formula. Now what I need to do is simply equal the risk-free rate plus the beta times the excess return given by market return, take away the risk-free rate, and that is my CAPM given rate of return. So now I have found this, so I can copy it across. So you can see this can be copied from here all the way to the remaining cells, which is this. Now I have found this. The next thing I would like to do is to identify what form of dividend growth policy is being implemented by these companies. We've already seen in case of General Motor, it is simply 0.38 pence for all 5 years. Of course, the first dividend payment is 0.36, but we can see it's 0.38 cents almost everywhere, so we can simply assume that this is zero growth because the dividend doesn't change at all. So we can also make a diagram to illustrate the same concept, which is this one. Of course, this line should be flat. It is not looking flat, mainly because, again, because of 0.36, which is what we see in the beginning. But if we delete it here, you can see that for all other periods, it is flat. So I will just leave it here like this, because we have assumed that dividend doesn't grow, which is the case here. Now, in the case of Walmart, now we can see how is the dividend growing. So you can see here it is growing at a constant rate, which is shown by this diagram, and therefore I can put this diagram next to the one by General Motor, and that's something evident here, constant growth. So if we wanted to see, we may as well be able to see it in terms of percentage change. So that's giving me 2% roughly, and that's something I want to implement in other cells as well. So here 2%, again here 2%. You can see I'm applying for Walmart, so it's coming 2% all the time when the dividend paid amount is changed. So therefore we can say the growth rate is constant, which is something we also show with the help of the diagram. Now we can see it for Microsoft, and for Microsoft again, when we draw the diagram, we can see again this is constant growth in dividend, so we can keep it next to the Walmart diagram, which is here. So therefore again we can say this is constant growth. Now the last company in our list is ExxonMobil. Let's see for ExxonMobil the dividend growth rate. This is slightly different. It sounds constant, one rate of growth rate halfway through, but halfway through it seems to have changed. So this then basically means this company ExxonMobil can be considered as one which is having a non-constant dividend growth rate. So this then basically means we have concluded different forms of dividend. This was zero growth, this is constant growth, again constant growth for Microsoft, but non-constant for ExxonMobil. So now what we want to do is we want to find out what is the growth rate in dividend, and that will help us find out a next year dividend. But first, last year dividend. So last year dividend will be the dividends paid in 4 different quarters, 1, 2, 3, 4 quarterly dividends taken together. That is the last year dividend that was paid, and same for all other companies. We can see how much dividend the shareholders received by the end of the year. Now in terms of growth rate, we've already said zero growth, so we can simply say 0% here. But in case of constant growth for Walmart here, what we can do is we can say equals the dividend in the end divided by the dividend in the beginning, which is 0.49 power 1/5, take away 1, is what we can do. So that's what we have done, because that's 5 years. And it is same for the Microsoft as well. But when it comes to ExxonMobil, because we are assuming this is non-constant, we may like to see when the non-constant period starts. So here this was for General Motor, this is for Walmart, this is for Microsoft. We don't need to compute, that's for ExxonMobil, but for example here for General Motor it will be 0%. Again, everywhere it will be 0% for General Motors. And now let's see for ExxonMobil. For ExxonMobil here, in between these two we can compute, which basically means we can find the rate which is 3% here, and there is a difference. So when the dividend was changed, again that's 3%, but between here, what is it, is we can find, oh, that's 6%. So we can see it is not constant, it is non-constant, but it's 6% again here. So what the story here we can assume is halfway through of this 5-year period, the dividend is non-constant, but after that it is constant, as we can see. And we can make the same assumption that in the next period again it will grow at the same rate. With that assumption, what we can do now in order to compute the growth rate is we can just compute the growth rate from halfway through then, which is equals open bracket 0.87 divided by halfway through will take us to 10 of them, because we've got 20 quarters, so it should be 1 2 3 4 5 6 7 8 9 10. So this one here, and power 1 divided by not 5 but 2.5, take away 1. So that will give us the constant growth rate of ExxonMobil, which only starts halfway through. So that's the growth rate we have assumed will take place for future dividend, but we have also assumed that this will remain constant, similar to here and here for Walmart. So now what we can do is find out next year dividend, which basically means we have last year dividend times 1 plus the rate of growth will give us, so in this case it will remain the same 1.52, which is what is the case. But moving ahead, for other two companies they are different, and for ExxonMobil this will be different as well. So it is not 3.48 but 3.56, because that's the growth rate that we have considered. Now what we need to do is to find out the theoretical price for different assumption related to the dividend growth rate. So theoretical price for General Motor, which has zero growth in dividend, can be computed using the formula, which is simply the capitalization of the dividend, which is given by this formula here. So I'm going to copy this, paste it here, and you can see that the formula is this. So basically dividend is divided by the required rate of return, which in this case is CAPM given return. So very quickly now, this is the dividend for the next period divided by the CAPM given return, which is this number here, which gives us the $10.07 as the theoretical price of General Motors share. Now we need to find the share price for Walmart and Microsoft. Now Walmart and Microsoft have constant growth in dividend, and for that the formula is this one here. So I'm going to put it on top, which is this. Let me minimize it so that it fits here a little bit more. Yeah, perfect. Now what we need to do is dividend next period, which is DIV1 divided by the required rate of return, which is CAPM given, take away the growth rate, which is what we found just before, and therefore this is the fair value of Walmart share price. And then same for Microsoft as well, but now it's the ExxonMobil, and in this case what we have assumed is the dividend growth is non-constant and constant afterwards. And we found that constant growth rate here, which is 2.40%. So which then basically means we need to apply this formula. So we therefore need to find out what is the dividend when it is non-constant, which is here, and then after it becomes constant, we apply the same formula as here, which you see is repeated here, but then this value needs to be adjusted because this needs to be brought into present value by simply multiplying it by 1 divided by 1 plus required rate of return for the time period. So now let's apply this, which is the last thing we need to do. So for this, we need to first find out the dividends at non-constant period. So let's do that. So dividend for non-constant period for ExxonMobil therefore is 1, 2, 3, 4. So that's 4 quarters in a year. So we can therefore say equal sum of these 4. And again, 1, 2, 3, 4, you can see this is taking care of the second year's 4 quarterly return has been added. Now we said halfway through, which basically means we need to add these 2 dividends as well. So what we therefore need to do now is for these 3 dividends, we need to find out the present values. That's what this formula here is telling us. Find out the present values of the dividends when they were non-constant. So that's what I'll be doing here. So I need these 3 numbers, and here I'm going to write 1, 2, and 2.5. And where it is 1, it is going to be this amount of dividend, and where it is second year, that's 3.04, and when it is 2.5 years, it's 1.54. Now I need to find out the present values, which is basically the dividend divided by 1 plus the CAPM given rate of return, and we're assuming it will remain constant, which is 14.46 here. So close bracket, and you now need to link it with the time, which is year 1 for the first. So that's what you do, but remember to lock the CAPM given rate of return, and after that you can just drag it to apply it for the other periods. Now add them all together, that is giving you 6.00514. So this then basically means you have computed for this part. So this part is giving you 6.00514. Now this part is remaining. Let's first find out for this, which is exactly this formula here. So for that, now what we can do is we can find this over here, which is dividend next year is this amount divided by the CAPM given required rate of return, take away the growth rate, which we said is this amount. So this then basically means this is giving us the P0 given by this formula. Now this one needs to be discounted by this. So therefore what you need to do is equal this times 1 divided by 1 plus again rate, which is 14.46 power. Now the time period here 29.54 is what you have done. Now remember, what is it? This is something you are going to receive. We said halfway through, because from halfway through this will be a constant growth in dividends. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that point onwards, we said it will be constant growth. so that is 2.5 years. So therefore what you can do there is have the information which is power 2.5. So that is the period you have linked. You can close bracket now, and therefore you can hit enter. So let's check once again. This was 29.54. 29.54 times 1 over the rate. This is what we are doing. 1 over the rate 1 plus RE times power 2.5, that's n. So that gives us the discounted value for this P0, because this P0 is only going to appear after 2.5 year time. So that's how we get 21.07. Now we have computed this. We need to add this remaining. So over here, what we can therefore do is add that 6 point something that we had computed, which is this figure here. So therefore that 27.08 is the theoretical price. Now that we have found the theoretical price for all different uh, dividend growth models that we assume, which is non-constant, constant, and zero growth, we can now compare it with the market price of the share. So if we compare, we can see that there are differences. So market price take away theoretical price. So zero growth dividend for General Motor is saying it should be $10.07, whereas the market price is $38. So this is overpriced, and therefore you can apply the differences to find out by how much the market price differs from the one given by dividend discounting model. We can see that there is some substantial differences. Now it could be due to different factors, including the limitations of the model, such as the CAPM given required rate of return remains the same throughout the period, and so on. So what you can do therefore is see, for example, you can change the market rate of return if you think that the market S&P 500 doesn't, let's say, represent Microsoft very well. So you can make some changes, but this is what is given by the theoretical model here, dividend discounting model, which we used to compute the price of the stock. Thank you very much for your time, and thank you very much for listening.